The Road to Autonomy is presented by the Road to Autonomy Index. The Road to Autonomy Index is a rules-based equity benchmark index that measures the performance of a basket of global companies that are involved in the development and commercialization of autonomy. Institutional investors and fund managers are watching megatrends that are shaping investment opportunities today. These megatrends are creating thematic investment ideas and opportunities for forward-thinking investors. We believe that one of the biggest megatrends today is autonomy. That's why we created the Road to Autonomy Index, the world's first and only pure-play index to track the thematic investment opportunity in autonomy. Follow the Road to Autonomy Index on your favorite finance app by simply typing in the ticker Autonomy. To learn more about the Road to Autonomy Index, visit roadtoautonomy.com/index. Hello and welcome to the Road to Autonomy. I'm your host, Grayson Brulte. On today's episode, we're absolutely honored to welcome back Dean Foreman, Chief Economist, Texas Oil and Gas Association. Dean, welcome back, sir.
Grayson, thanks so much for having me again.
It's always great to have you here. I look forward to our quarterly episodes because you have wonderful insights into the oil markets, because oil plays a vital role in transportation. Without oil, the transportation economy doesn't work. Dean, as we always kick every episode off, what is the current state of the oil markets?
Well, looking out the window this morning, we've got Brent or European crude oil over $90 a barrel. We've got American West Texas Intermediate crude oil sitting around 88. And the news that came out yesterday, the statistics buried inside baseball from the U.S. Energy Administration are fascinating. Consumption in the U.S., 21.9 million barrels per day for the week ended October 13th. That exceeds its 5-year range. This is off the top. So consumption here, despite all the economic concerns, has been strong. And the thing the market really pays attention to are inventory levels, right? And you've got two flavors of inventories. You've got ones held by industry, commercial crude oil ending stocks. Then you have strategic reserves. And with a big draw again this week and several big draws over the last couple of months, the commercial crude stocks, the main indicator the market watches, are in the lowest 5% of their 5-year range. On top of this, the strategic reserves that the market doesn't watch as closely because they don't usually change so much, those are at the lowest level since 1983. So yeah, almost 40-year lows, Grayson. So this is pretty amazing. It means it's a tight market. And despite everything that's been going on, we really have tightness to watch in terms of supply and demand and where that supply is going to come from to meet the demand.
Where's the demand for oil coming from? Is it coming from the commercial side, the trucks? Is it coming from barges? Is it coming from consumer demand? Where's the demand coming from?
For the U.S., it's really interesting because gasoline demand, especially through the summer, was historically weak. In fact, in recent weeks, it's been below its 5-year range. But what has been hitting on all cylinders and traditionally has been a pretty good economic indicator is one, jet fuel, about 1.8 million barrels per day worth. So that says people are traveling, cargo is going. Diesel fuel, over 3.6 million barrels per day of that. That says that, again, transportation and industry are moving forward. And then quietly, over 6 million barrels per day, or we call it, it's a bucket called other oils. So this is naphtha, gas oil, propane, and propylene. These go into the refining and petrochemical sectors. They're energy, but they're also materials. And people forget that 96% of the consumer goods that we appreciate, whether it's performance materials, plastics, medicines, the iPhone, everything that we've got, in some way, shape, or form, a lot of the pieces of that start as oil and gas. The basic molecules and the heavier molecules feed the plastics.
Crayola crayons, we had the news, 2 weeks ago, where Lego is going back to petroleum because it didn't work. I mean, that was not a shocker to us because we know that, but that was a shocker to certain individuals there in the market. So jet fuel, so we're at 1.8 million barrels per day. Does that continue to grow as we go into the holiday season, where Thanksgiving, historically very big travel season, we go into Christmas, or is that going to slow down as the economy slows down?
Well, I think there's some of both. It's always a seasonal kind of product. And during holiday season, you'll expect more travel and you'll probably see it go up in December. But outside of that, as the economy goes, if you're looking on an annual basis, if the economy is growing, you don't generally get more air transportation. The 2020 pandemic decoupled that for a while, but we've really seen it come back. And if anything, some of the planes that went back in service were less efficient. So that's another aspect of it.
I noticed the planes I've been on like the last couple of weeks, they've been packed, sold out, actually. The consumers are still flying. What concerns me is the consumer debt they're putting on credit cards, and those bills are going to come due someday. And what impact's that going to have on the company? We all know Chairman Powell's watching that, but that's a conversation for a different day. When we look at the economy, we look at global geopolitical issues. We have the war in Gaza, and Yahoo recently came out and said it's going to be a long war. We saw what's happening with the fertilizer market because of the conflict. What impact is the war in Gaza having on the oil and gas markets now?
It's pretty clear that it's put a premium on global oil. I mean, no question about it. For natural gas in particular, with the Leviathan field that's right offshore Israel, along with Mozambique, is a reminder that sinking tens of billions of dollars into fixed investments that sit next to a war zone is not the most palatable option. So the consequence of that, and this is both for oil, refined products, as well as natural gas, is that being able to source out of a place like the U.S. Gulf Coast, where you have political stability, reliability, a lot of volumetric growth, it implies a premium for U.S. products. Now, the administration, though, if that's going to work for American consumers, you've got to have production through the entire value chain, access to resources, building infrastructure, a lot of cogent energy policy to go with it. I don't know if you noticed the headlines this last week, but the Biden administration is announcing a tentative deal to lift sanctions on Venezuela to try to get more barrels from Venezuela. So each time we've gone through these geopolitical variations, first with Russia, Ukraine, vis-a-vis playing Iran on that with the administration, and now reaching more toward Venezuela, they're trying to get barrels quietly out of OPEC Plus without necessarily putting really stringent secondary sanctions on Russia that would take Russian volumes offline. They could, but they haven't, because they know that global oil markets can't really survive without those volumes coming to market. And quietly, there's still a lot of hedgerows that have made it very difficult to continue to expand domestic production in the United States at the pace that, frankly, the demand for U.S. exports has continued to say that it's likely to be necessary. So it's going to be an interesting reconciliation over the next few years.
Let's fast forward 12 months when Maduro, the president of Venezuela, has told the United States that he'll guarantee free and open elections. I study geopolitics. I'm holding my breath, and we'll see. So let's just say, let's look at the history with Chavez, Maduro, and Venezuela. He's going to go back to the old days. Then what happens? Do we cut off all of that oil supply? And if we do, and we have the conflict in Ukraine still raging, what happens to the oil markets? What happens to supply and demand?
It's interesting because I don't know if it's really been thought through of what's necessary to increase production coming out of Venezuela. So if you want to do that, and through the Orinoco Belt, a lot of this is more complex operations with heavier oil, it's not easy. So you're going to have to put real know-how, real dollars, real capital in to make that happen. U.S. companies really got burned with the expropriations 20 years ago. And Chevron specifically had some sanctions lifted and has a green light to increase some things. But would they be willing to put real dollars and cents and real people on the ground trying to operate in that environment? It's not clear. Now, if they can bring in Chinese capital, and they owe a lot of barrels to both the Chinese and the Russians, we'll have to see. So I don't know if it's been thought through in terms of just lifting the sanctions, the timeliness with which you could attract investment. I think it'd have to be a credible, enduring change. You probably would have to see some traction on the political change, real change, to attract the investment that would actually increase the supplies. So I don't see this as actually the hope of getting near-term barrels. This isn't like Iran, where they might be able to produce a fair amount of volume in a short period of time. I think it would take much more.
It's scary. The more I think about this, what you said, we haven't thought it through. So let's just say China controls the electric vehicle supply chain now. That's very well known. They control the global semiconductor. We're trying to offset that with what's being built in Arizona. But then you have the chairman and founder of Foxconn coming out saying it's not going to work because of the economics. So China marches into Venezuela. Now they're controlling a big chunk of the oil supply. We're right back to where we started again. It just thinks that we have to think things through because we have a record high global oil demand of 101.3 million barrels per day, and historically low U.S. crude oil stocks, currently at their lowest level, I might add, since 1985. Venezuela is opening up, if you want to use that term. This raises the question, where are we heading? Because it seems that geopolitics are going to become front and center now.
There's no doubt the market's recognizing the tightness, and the focus on the inventories, I think, has become more apparent to markets in recent weeks in particular. This is why we're sitting $90 is not extraordinarily high by historical standards, but it's above the long-term average when you adjust for price inflation. The biggest thing that's kind of kept the market in check, actually, from a oil price standpoint over the last 2 years has been this increase in U.S. interest rates, which has strengthened the U.S. dollar. And at the same time, that's forced financial market participants to factor in the prospects for what you were mentioning of households under pressure and slower economic growth. And normally that's a downdraft for oil prices. So as much as the market's been tight, people have kind of ignored it. And the financial market trading where the prices are established hasn't actually had that much traction. The geopolitics on top of it, with the tight fundamentals in terms of the low inventories, that's real. Venezuela opening up, think of that as on the margin. China will take some more barrels that otherwise prevent China from importing from somewhere else. China is now the single largest importer of crude oil, over 13 million barrels per day in the world. So a big part of the traditional push by China to get into electrification wasn't just to strategically control the value chain. It was to prevent, as their economy grew, an unsustainable growth in their oil imports. And they're pressing that, right? They need a lot. They have a voracious appetite for it. And as their economy grows, it's still relatively energy intensive compared to Europe, the United States, or other advanced economies.
Petroleum is not just going into vehicles, it's going into the economy, it's going into building materials. And we saw the building boom. This looks like it's turning into a building bust in China, but I'm not an economist on real estate, so I'm not going to comment on that. But I'm curious, 13 million barrels per day China's importing. Vladimir Putin, president of Russia, recently visited President Xi in China, one of his first international trips since the conflict in Ukraine began. Is that signal that more oil might be going to China from Russia, or where is that oil coming from for China to import?
There's no question that Russia has been sending more to China, and especially major Chinese refiners that might not have international operations that would interact in any way with the financial system and the sanctions that have been put on Russia. Then it's more of a game to figure out how you can get the volumes. Javier Blas at Bloomberg has made the point that Malaysia's crude oil exports, for example, are roughly 3 times to China the amount that Malaysia can produce of crude oil. So it is Russian barrels that are furtively finding their way creatively onto markets, both on the crude oil and the refined product side. Markets have popped up in the Mediterranean, in Asia, where ships get offloaded, things get mixed, and it becomes harder to trace after a point. So this is the way it's worked. And it's not that the US and others couldn't use secondary sanctions that actually make it very punitive to take any Russian volumes. But given that Russia's producing and exporting substantial amounts, I mean, their production's still consistently around 10 million barrels per day and very close to what it was before Russia's war in Ukraine escalated. This says that there really isn't the political wherewithal to try to punish Russia and punish global consumers in that way. The volumes truly are needed at a time that we're seeing a record amount of global economic activity, a record amount for next year of global oil demand. And you don't get there. You don't make supply and demand match if you take roughly 10% of the market away.
You don't. And Javier Blas, I got to give him a shout out. His book, The World for Sale, it's coming true when he tells these great stories from Mark Rich and the oil traders, and they're getting the guy with a bucket of paint on the back of the ship, and they would change the name and change the flag, and away it went. It seems that his book is real life now. So to my friends in Hollywood, there's a movie there. You can make a movie based on what's happening today and what's there in Javier's book. So you mentioned demand. So in 2024, the U.S. Energy Information Administration is projecting a demand of 103 million barrels per day. I repeat, 103 million barrels per day, an increase of roughly 200,000 barrels per day year over year. Is that trend going to continue, or are we going to have phantom oil that magically shows up, or what's going to happen there?
Well, where the supply will come from, we should talk about as a separate issue. But on the demand side, and they've just revised their numbers, right? So in the October forecast, the revision that EIA has put out in its short-term energy outlook, they're showing demand this year exiting around 101 million barrels per day, going to 102.2, 102.3 in that ballpark for next year. So it's growth of 1.3 million barrels per day through 2024. That's about right, by the way. That jibes with our historical relationships with what we expect from economic growth that's close to 2.5%. So intuitively, that's the relationship of what the world should need in terms of incremental growth. Now, think of it this way. OPEC's supply declines naturally. The wells decline by 3 to 4% per year. In the US, it's more like 7 to 8% per year. So now you've got natural decline that's going to add several million barrels per day of needed new oil that has to be invested in, discovered, developed, brought to market, on top of the fact that you've got growth of 1.3 million barrels per day. The issue is, do you have enough investment to make that go? The only places you can go and get barrels relatively quickly are either OPEC, if they have spare capacity, or from the United States with shale operations. And right now, the U.S. is, both this year and again next year, consistently, by all official forecasts, whether it's the EIA, the International Energy Agency, or even OPEC, they're assuming that the U.S. is going to be the largest single source of growth of oil supply in coming years, not just next year. That's important because that means we can use the better data and the indicators that we have here at home to try to gauge, are we on track or not? And we've seen record production this year. U.S. crude oil production, I don't know if you noticed, the first week of October struck 13.2 million barrels per day. That's a record high. Our previous high was in March 2020 of 13.1. We really have struggled to get back to those kinds of levels. So this says that, despite everything and with lower investment in drilling activity than what we've seen back then, the process innovation has helped. The productivity of the geology has continued to be strong. And we're also seeing a tailwind right now of wells that were drilled in the past, but not brought to market, not completed, so to speak. We call them DUCs, drilled but uncompleted wells. And those are also contributing. And by the US EIA's estimation, there's another 2,800 of those DUCs, sitting around ready to be brought to market.
With the U.S. being the largest source of growth, is that one of the reasons why ExxonMobil recently agreed to buy Pioneer Natural Resources for $59.5 billion in an all-stock deal?
Well, I think they have multiple motivations, and they're really thinking forward in terms of the long-run energy transition and what it means for oil markets. So first, it increases this deal. It has to go through legal approval, but it increases the concentration of their resources, basically doubles their position in the Permian Basin in Texas and New Mexico. As those get developed and the geology doesn't have as much resource in place anymore, it means that they can use enhanced recovery by injecting CO2, for example, back in to try to increase the reservoir pressure and produce more over time, increasing the ultimate recoveries. And then lastly, at the point where the resource is depleted, it gives them pore space underground to be able to use for carbon capture, use, and storage. So through the low carbon business that they're growing, this is a concentrated position then that would really help the entire future of the company. So it makes sense in multiple ways. I think from a Texas perspective, it also means that the ultimate recovery of resources is likely to be more efficient in that kind of scenario and higher. It's worth noting that in September, the Potential Gas Committee, which resides at the Colorado School of Mines, every 2 years they do an update of the resource base in the U.S. on the gas side. And they've shown that that's at an all-time high. It's continued to increase despite the fact that we've seen relatively or historically low natural gas prices in the last year or two. So that's important. And I think with this, potentially a really exciting combination for the industry, and we'll see where it goes.
Is it a validation of the Permian Basin and what the opportunity is there?
I think it does. I mean, it really does show that it's both the quality of the resources, the business climate that exists in Texas, the infrastructure that exists in Texas. And as this premium that we were talking about for U.S. products continues to grow, you really are looking at an environment where the Permian Basin, Texas, Gulf Coast, whether it's for domestic use or for exports, it works. And it's the quickest place you can get to market and build everything that you need. So it's both a validation for the basin, but also the state of Texas.
Texas is doing wonderful and spent a lot of time there. Saw you there recently. It's interesting you highlight the carbon capture with Dan Ammann, former CEO of Cruise, is leading that low carbon business now for ExxonMobil. We met up in Texas. I got to ask, and we're going to dial in on Texas. What impact does this have on Texas economy and the state's oil production? Will we see a positive economic benefit? Will we see a potential increase in the state's oil production as well?
I think yes and yes, and it does matter on the time frame here. By our estimates, and the Texas Oil and Gas Association, we're publishing a monthly energy economics review that provides not only our own production forecasts up to the current month, whereas some of the official ones from EIA and others are well in arrears, at least by 2 to 3 months. We're we're putting that in context with the entire value chain for petroleum and for natural gas. So filling in a lot of the missing statistics in the public arena. And it really does show that we have, as of September, we estimate that Texas produced 5.9 million barrels per day of crude oil, additional natural gas liquids on top of that. It's been hitting on all cylinders, and not just its own production, but through the value chain, enabling the production from New Mexico, Oklahoma, and other states to come to market, be processed, be exported, and find markets both domestically and internationally. So when we look across the state and you add up in the GDP figures, all of the sectors that are either directly related to extraction or follow-ons with energy intensive and related activities, be it transportation and warehousing, pipelines, natural gas distribution, those add up to more than 40% of the economy straight up at that point. They've accounted for, in this environment, and especially times when you see prices going up, the majority of the growth coming out of it as well. If you go down to localized areas like the Houston area with the Houston Ship Channel, Corpus Christi, the coastal bend with massive port and a good portion of the refining capacity that exists in the state. These are areas that are especially turbocharged by having these kinds of activities. So oil, gas, through the entire value chain. It's the manufacturing, it's the processing, it's the exports as well. And the workforce is there as well. So again, good for hitting on all cylinders, although Texas has a reasonably diversified economy and has continued to diversify over time.
You have to give a lot of credit to Governor Abbott and the state legislature. It's become a tech hub. It's become a major tech hub. Large corporations, Tesla's moved there, Oracle's moved there. Obviously, Dell was founded at the University of Texas, Austin, but there's a really great tech ecosystem that's helped diversifying the economy. And then you have your agriculture and your cattle business. So to me, it's a well-rounded, diversified economy. It's not a one-trick economy. That said, so for the first 8 months of 2023, Texas has driven 43.2% of U.S. oil production. That's impressive, Dean. It's highest since 1981. That's 41 years ago. What's causing this gain in U.S. oil production? It's only going up.
Year-to-date average basis, it's 43.2. If you actually take the numbers that I just gave you of 5.9 million barrels per day of crude oil production relative to, for averaging the weekly numbers from EIA of just under 13 million barrels per day of production nationwide, that's actually closer to 46%, 45 to 6, and growing, right, in the way this has been going. So U.S. production, it says a couple of things. First, that Texas's role, the business climate, the infrastructure, the resources has been growing for obvious reasons. Side by side, compared with other states pre-pandemic in the shale revolution, though, other states haven't played or had the activity level and recovery to the same degree. So Texas is hitting records, right? But that's really not the case in Colorado or Wyoming or North Dakota or even Oklahoma. New Mexico, they've had a lot of substantial growth in the Permian Basin side, so they're doing great. And on the natural gas side, Louisiana's really been carrying the weight as well. But those three states, Texas, New Mexico, Louisiana, outside of that, I mean, this Gulf Coast and Southwest region really is what's carrying the water for the shale revolution at this point.
So you have the shale revolution there, but then also, is it the ability to export? Since you have the port of Houston, you have refineries there. Is it the ability to refine and export the oil? Is that one of the advantages as well?
It's both on the pipeline side, and Texas has a fundamentally different pipeline system in terms of regulation than most other states. It's essentially you put your capital at risk, you build and you privately own these pipelines. So companies that build those are doing so without any guaranteed rate of return that you would have, for example, in a FERC interstate regulated common carrier kind of environment. And that's meant that Texas has historically been a place where you can attract capital and build things relatively quickly. The intrastate liquids and gas pipelines, especially the gas pipelines, are increasingly important. The gas takeaway capacity, being able to get those to market and doing something with that, has been increasingly important in an environment where you have environmental sensitivities to not flaring in operations, so not just burning methane openly. You're putting a gathering system in place with the oil and gas developments to make sure that you're capturing that increasingly as you produce it so that you don't flare. And as that goes to market, then all of this is advantaged. That queuing up the ability to build it quickly and in a sequence doesn't work in concert in other states to the degree that it does in Texas. And it's one of the advantages that Texas has had.
Are the pipelines running from the Permian Basin, from the oil areas down to the port? or are they running interstate? Where do those pipelines traditionally or historically run?
Well, you're right. They run toward the coastal areas, but that can be toward exports. It can also be toward the population centers, Dallas, Houston, San Antonio, Austin, where you have more natural gas power plants as well. So using it through the value chain, it can go to any energy intensive manufacturing. So you've seen a lot of, whether it's refining or petrochemicals or manufacturing that requires a lot of process or heat energy. You've seen a lot of that get built out over the last decade along the Gulf Coast as a result of the energy revolution and everything that's been in abundant supply and low cost as a result of that.
For the first 7 months of 2023, Texas exported $125 billion of oil, natural gas, and derivative products. Where are they being exported to? Is it going to other states? Is it going overseas? Where is it going?
It really varies by product. If you think about, and let's break the 125 down, crude oil, the light, sweet crude oil, so low sulfur, kind of liquidy crude oil that we produce here in Texas and through the shale revolution, $57 billion worth of that, predominantly going to Asia and Europe. And then the next step of that is natural gas. And you've got almost $40 billion of refined products. The refining sector would be the next. That's almost $40 billion. The majority of that is going to go to, it's a story about the Americas. So it's Mexico. There's some going to Canada, but Central and South America and the Caribbean as well. Natural gas is $13 billion. And the news there has really been a shift towards Europe. So traditionally, we sent a lot of that to Asia Pacific. Some of the offtake capacity is owned by the Chinese and others. But through the last year, especially as Russia's war in Ukraine escalated, and then the Nord Stream 1 and 2 pipelines were damaged or blown up, destroyed, that's gas that just physically will not flow from Russia to Europe now. So they're replacing that both through a combination of demand destruction, so rationing and lowering the amount that industries are taking. Prices themselves have done that at times, but also just by trying to secure as many of the free cargoes or available cargoes of liquefied natural gas globally that they can get. Last year, the Chinese were perfectly willing to give those cargoes up with slower economic growth. 70% of U.S. liquefied natural gas exports this year have gone to Europe. And the question really, as we get into winter, especially if it's a cold one for Northern Hemisphere, including Asia, is whether China will continue to cede those cargoes to Europe or whether it's a bidding war for those cargoes. And we'll see how that plays out. And quietly, beyond natural gas, there's another $16 billion of hydrocarbon gas liquids. So think of that as liquefied petroleum gas, other things for cooking, for heating, for energy. That mainly feeds Asia Pacific. It doesn't make the headlines, but it's been a vibrant and growing source of exports as well from Texas.
13 billion nat gas export. You said a majority going to Europe. If we have a cold winter in Europe, the Ukraine-Russia conflict continues. Obviously, just the Economist to me says prices go up. And then will we see Texas try and export more natural gas to Europe depending on what the weather conditions are?
The issue is with liquefied natural gas and with gas pipelines, you have a certain capacity, and we've been basically exporting very close to the capacity. So for this winter, you can only export the amount that we have. And by EIA's estimates, the U.S. Energy Information Administration has shown they've estimated net exports of natural gas between 13 and 14 billion cubic feet per day for this month. That is a record high in the last 2 months. We'll have to see as winter approaches whether they can eke any incremental increases out of that or if there are more trains that will start up. They do project another 1 to 2 billion cubic feet per day of growth in that over the next year or so. But again, if we take this out further in EIA's view, it's increasingly an artifact of a gas model of the market as opposed to the reality of permitting and having built it. So here's an example. If we go out and take EIA's view to 2030, not just next year, right? They show an over 80% increase in gas exports from the United States in their annual energy outlook. That is like 9 billion cubic feet per day of increased exports. And the facilities don't exist today to do that. You'd have to start building them now to make that happen by 2030. But in addition to that, I think the thing is that they don't show nearly that kind of increase to 2030 in terms of U.S. production. The way it comes together in their view is that they're assuming that a lot of natural gas gets backed out of the U.S. power sector, electricity generation, by virtue of wind and solar growth. And that might kind of politically flange in terms of thinking of the wake of the Inflation Reduction Act and the incentives, the strong ones for wind and solar. But the amount of intermittency, what we've seen, especially in recent months through the summer here in Texas and ERCOT, is that the complementarity of natural gas with increasing renewables penetration is critical to have a stable and reliable grid. Without the natural gas being used, you can't compensate for when you don't have these intermittent sources. So if you don't have solar at night or wind blowing at certain times of day or during the winter, these are issues. And we need to make sure that it all ties together cogently. Right now, if policymakers were accepting that outlook, if Europe were accepting that outlook, you'd plan very differently than understanding, where by hedgerows you actually have serious needs for some decision points in U.S. energy policy to make that become a reality.
A very dear friend of mine says, how great would it be if we just had common sense? And you look at things through a common sense lens and not a one-size-fits-all. So we got the 80% increase in gas exports in the United States. You mentioned that we have to start building the infrastructure. Do we even have enough natural gas to meet that? Or is this just hypothetical? I mean, where is this coming from? Is the demand there? And then I'm going to ask you on the backside of that, how hard is it going to be to get permits to go pull out that natural gas?
The potential gas committee study that I mentioned, there's no shortage of resource. The gas is there. And even the gas in the Permian Basin, the Southwest region is there. That's not the issue. The ability to develop it on scale and have the infrastructure and all the takeaway capacity, that becomes more challenging over time. But 9 billion cubic, an 80% increase in exports, to build that degree of increased export facilities would take a concerted effort, right? Think of the workforce challenges where simultaneously building just a few of these export plants can take substantially all of the craft labor of certain classes, be it electricians, high pressure welders. You really need to get on it if that is the kind of direction that is likely to go. So we have to separate an artifact of economic modeling from the market reality. It does say, and the geopolitics, Israel's war with Gaza Strip, all of that now says U.S. LNG exports, U.S. crude oil exports, any product you can get out of the U.S. should be at a premium on a sustained basis. Texas is really the nexus to make that happen.
Texas is to make this happen. And there's no doubt about it, because in Q1 2023, the Texas and oil and gas industry produced 200% more output than 2005. So by 2030, is it going to be 300% more output?
When we make the long-run historical comparison, and this is in our last quarterly outlook, right? We compared the employment base in industry over time with the total oil and gas output from Texas. And roughly, the story goes like this. Through the early 1990s, the employment base and the product production kind of went hand in hand. Mid-1990s, there was some slippage in productivity, and you were actually, without laying off people, you were producing less. I mean, it was actually backsliding. But by the time you get to 2005, first with the experimentation that led to the shale revolution in the Barnett Shale in Fort Worth, Texas area, Dallas, Texas area, you get from 2005 until even today an exponential increase. So this is where you're getting the 200% literal increase in the amount of oil and gas on an energy equivalent basis that's been produced. And we have increased our employment, but we're still sitting 440 to 50,000 people in Texas. It's 30% higher roughly than it was back in 2005. Whereas in the 1990s, it just kind of cruised around 400,000. So we're up there. It is growth, and we'll see now where that can go, but we wouldn't repeat the shale revolution again, right? And that's the experience, the once in multiple generations kind of experience with a breakthrough in technology that we've seen that's really increased the productivity. We've been able to take advantage of the resources and the endowment that Texas has been blessed to have. We'll see where that goes in the next 20 years. But it's clear that as the economy is growing, that the global demand for oil, the global demand for natural gas has continued to grow to these record levels. And if that's not coming from Texas, from the Gulf Coast, it's not clear where it's going to come from. So the pervasive belief before the shale revolution was that if demand got to these kind of levels above 100 million barrels per day, it could be very difficult to sustain that from a supply standpoint with the conventional resources that existed, increasingly concentrated in countries that weren't as friendly to the United States. But with the shale revolution, we've unlocked through technology the potential to take the source rock for a lot of the conventional oil and gas and turn it into productive things. As we look through fixed lenses today, we see the potential to continue the U.S. energy revolution, grow these exports. We still need energy policy to make that happen. And it's going to take both state and federal support for that to continue to grow on pace. There is the potential to take that technology and grow it globally as well. The resources are almost unlimited in terms of the global potential, particularly in the natural gas side. We'll see where that goes. So far, the above ground issues, the permitting, the water, political wherewithal, that hasn't existed in most other countries. Argentina is growing, but we'll see. We'll see how that plays out.
You stepped into Argentina. They're about to elect a new libertarian president. What impact will that have? Will he just completely enable free markets to run based on his ideological base in Argentina? And could more oil come onto the market if he does take a full libertarian free market approach?
I can't predict where Argentinian politics will take it. I think the one thing that is clear is that the economy has needed real value to stand on and grow. And oil and natural gas have been that for them in recent years. So the Vaca Muerta formation and the amount of growth has the potential to make Argentina an even larger exporter of these things. We'll see. It has to, part of having a stable environment and not having hyperinflation, you have to have a stable macroeconomic environment to attract companies with major investments. And this is compared to Venezuela that we were talking about earlier, right? Argentina is a much more known commodity in terms of its stability compared with Venezuela. And that's not to put Argentina on a pedestal. It's a very difficult place to do business, but the resources are world class and the potential for growth is there.
The potential's there if they can get their hyperinflation under control. That's step one, is get their hyperinflation under controls. We have inflation here in the United States. The Fed's trying to break the back of it. Not so successful yet. And then I've been studying a lot of different reports that have come out from the major U.S. banks, Bank of America being one of them, where they keep talking about this labor-light economy as we go into a recessionary environment, that the jobs aren't going to come back earlier. You mentioned craft labor. So are we seeing more automation technologies come into the oil and gas industry because those skilled jobs aren't there where a robot and automation could do some of those jobs? Not all those jobs, but some of those jobs?
Absolutely. And I think all of the things that have been said from Elon Musk and others about the potential for AI to have pervasive labor market impacts in the next 5-10 years are really worth heeding. I mean, in our industry, in resource development, in the upstreams, as we call it, supervisory control and data acquisition, SCADA for remote drilling operations, pipeline flow monitoring, those are real things. Industrial, Internet of Things, IoT sensors, again, putting everything into processing and having real-time monitoring has been really important. The role of AI for below-ground issues, real-time learning, really targeting drilling, that's been important. In the processing, refining, and transportation of products, manufacturing based on them, areas like robotic process automation, RPA bots, and cost management, workload automation and scheduling, real-time pricing and trading, pipeline and well monitoring, automated reporting, regulatory compliance. I mean, there's a lot of areas that's today, and the potential as this continues to be cost effective and show scale, the potential as the technology fundamentally improves is almost unlimited. So I don't see a vision where you get rid of all people, but you really target the skills that you need and people using these tools effectively to find ways to be more productive. This is that next phase of the shale revolution or energy revolution where it can go.
You're seeing Imperial Oil. They're using autonomous trucks in the Canadian oil sands. They're shaving off several dollars off the price of the barrel of oil. And their chairman is saying, I need more, I need more, I need more on the earnings call. And that caught my attention. So you're starting to see it on that aspect. You're seeing the AI. And I think it's going to be very healthy for the industry because the oil and gas industry is one of the most profound industries in the world and has a very big impact, not just on the U.S. economy, but on the global economies. And staying on the economic front here, the International Monetary Fund, commonly known as IMF, is forecasting the U.S. economy will grow 2.1% this year and 1.5% in 2024. If the economy continues to grow and we end up with a soft landing, how are the oil markets react? There's a lot of chatter from analysts on Bloomberg and CNBC, soft landing, soft landing. It seems to be we're kind of moving away from the hard landing to the soft landing. I'm not going to pick either side because I'm still unsure. Either way, how will the oil markets react?
Oil markets, I think, have largely factored in that soft landing scenario so far. I mean, if they were expecting an abject collapse in economic activity, you would have oil much lower than it is currently. And now you have this geopolitical uncertainty, both due to Russia, Ukraine, but as well as Israel's war in the Gaza Strip. Might that mean something for Iran's supply Straits of Hormuz. I mean, it's touchy from an oil market or financial market perspective. The IMF's outlook, though, it's worth noting first that they do show it basically holding pat with slight, very marginal slowing next year. But the key thing in there, besides the things we've talked about, really is China's growth assumption. Goes from 5% this year down to 4.2% in 2024 in their assumption. That's a pretty, not sandbagged, but that's a pretty conservative assumption because other than the pandemic year, this would be China's lowest growth since 1990, literally. And they're infusing a lot of liquidity to support the real estate markets that you mentioned. As the global economy is doing well, the pull for Chinese exports, consumer goods, consumerism is very, very real, right? We're seeing that. And there are times when oil is really your leading indicator of what's happening with the economy. And the pull, both global demand, U.S. demand, pull for U.S. exports has been so resoundingly strong. The material side of that we talked about, really holding that up, that kind of tells me that maybe China could outperform here. That's an upside risk that contrasts with the weak expectations going into next year.
I study the luxury market a lot, and there are certain analysts that are saying that the sell-off in the luxury sector has been overblown because the Chinese consumer will continue to spend. Then you have certain analysts that say, oh, well, the Apple iPhone sales slow down, but I attribute that to the homegrown products there. You're still seeing a lot of Chinese consumers with a lot of cash on the sidelines that are spending. You have individuals trying to get out of the country, but the individuals that are on the mainland are still spending, and the outlook, according to Bain & Company, for the luxury sector is very healthy. And when the luxury sector goes, the oil sector is going to go because you have to get in your vehicle to go buy the luxury product you want, or the vehicle will bring it to your house. And guess what? You and I both know that runs on oil and gas. And so as luxury goes, oil and gas will go in China. That's my opinion. And your opinion, Dean, what is the outlook for the oil markets for the next 3 months?
Well, near term, we're going to have to see how geopolitics play out. But the thing that's clear on the supply-demand fundamentals is this tightness that we've talked about. It's different from an oil perspective than from a gas perspective. With oil, we've got a lot of transparency, at least among advanced economies, that the inventories are historically low, right? And where that supply comes from, if the economy is on track. And it's notable if we're comparing the official forecasts right now between, we've talked a lot about EIA. We haven't talked about OPEC or the IEA's forecasts. And side by side, I got to tell you, there's been an unusual conflict between them in the last month or so. And it showed up in the headlines where it began in September with the IEA revising its outlook to show a peak in oil demand before 2030. The EIA does not show a peak until 2045. And OPEC came out, absolutely slammed the IEA's view and said, nope, we don't see it before 2050. And in their view, they used very strong words and basically said that narratives like this are setting the global economy up for a spectacular fall. And the difference between the lowest and the highest among those three, between now and 5 years from now, by 2028, is a difference of 3.9 million barrels per day. Well, let's put that in context. Okay, so 3.9 million barrels per day compares to, in the last several years, substantially all of the growth that we've seen from all non-OPEC sources. So that if you were saying, okay, where am I going to get this if I can't count on OPEC to open up the spigots and bring it? What's that mean? It's substantial, right? If it's equivalent to basically everything that every non-OPEC source has brought in the last 5 years. So that's point one. Point two, in terms of just where this goes back to the conversation we were having of the big difference between the sources really is the assumptions around EV penetration and what it does in advanced economies in particular to oil demand growth. This is why IEA is on the leading edge of that, predicting that it'll roll over. EIA continues to see slow growth, but still growth. And then OPEC is basically saying, nope, the economy is continuing to grow. Emerging markets are the source of that. They're relatively energy intensive and they're on the high end. The stakes are high because the swing of 3.9 million barrels per day is roughly $200 billion worth of investment on the margin, right? 200 billion more. And if you want that 5 years from now, especially when some of this is conventional resource that has to be brought globally, that's 200 billion that has to be invested soon, not 5 years from now to get that. And that means a stress on capital markets, realization it's really an industry where it's hard to catch up once you fall behind in terms of investment. Where those barrels can come from is increasingly less clear. So this then puts you into different scenarios of thinking about the economic side. potential price scenarios that go with that, the geopolitics, the potential for discontinuities. And your mind can go and run different ways with this. But directionally, it basically continues to underscore the essentiality of having oil and gas. The difference with gas being that it's always a very regional and seasonal market. We talked a little bit about in the next few months supplying what will happen in the winter for Europe, right? That they'll reach for more LNG cargoes. The difference of not having the pipelines from Russia that they've had historically is that they can't backfill storage as fast. So if they have with full storage now, normal or relatively warm winter, they can muddle through. But if they need with a cold winter to backfill it, ouch. And we'll have to see what options are actually available besides demand destruction to make that happen.
Well, we're going to have to watch it. You're going to come back next quarter, and so we'll dive into that. You highlighted the EV penetration. We're seeing globally, consumers are starting to pull back from EV demand. It's starting to flatten, and consumers are opting for gas vehicles primarily because of the cost of the insurance, the cost of the vehicle, and that demand is beginning to wane. And guess what? We have to keep investing, as you and I know, in oil and gas, because as consumers shift back to ICE vehicles, despite the global shift towards clean energy, consumers still like their ICE vehicles. We have to continue to invest. Otherwise, we're going to have an economic calamity. You heard it here first. Dean, as we look to wrap up this insightful conversation, what would you like our listeners to take away with them today?
Well, I think we've covered all the bases. You never know the results or the outcomes on these things. There are always scenarios off of it. But we really try to look to the fundamentals at Texoga, Texas Oil and Gas Association, so txoga.org. People can find our economics section, and we are putting out a weekly chart book, a monthly energy economics review, as well as a quarterly outlook that gives the outlook on the economy, oil markets, and gas markets. Use those as resources, please. Feel free to reach out to me on LinkedIn or directly. I appreciate interactions and hearing what people have on their mind and the feedback about the questions that we should be looking at if it's not obvious. So I appreciate these conversations each quarter. I really enjoy the conversations. So thank you.
You're welcome. I thoroughly enjoy them, and your outlooks are fantastic to our listeners. I highly recommend you read Dean's outlooks. I'll link to them in the notes here. The future is bright. The future is autonomous. The future is Texas Oil and Gas. Dean, thank you so much for coming on the Road to Autonomy today.
Thanks, Grayson. Thanks so much.
If you've enjoyed listening, please kindly rate, review, and subscribe on your favorite podcast platform. Want to get in touch? Follow us on Twitter, Instagram, and YouTube at Road to Autonomy, or email podcast@roadtoautonomy.com. The Road to Autonomy podcast is produced by the Road to Autonomy, LLC. The views and opinions expressed in the Road to Autonomy podcast do not necessarily reflect those views of the Road to Autonomy, its subsidiaries, its shareholders, directors, investors, or partners. The content discussed on this podcast is for informational purposes only. It should not be taken as legal, investment, tax, or business advice. Nothing is a recommendation that you purchase, sell, or hold any security or other investment, or that you pursue any investment style or strategy. The content of this podcast is presented on an as-is basis with no warranties, express or implied, of any kind. Financial mentions about companies in the Road to Autonomy Index and discussions about the Road to Autonomy Indexes are for informational purposes only and should not be relied upon when making any investment decision. Furthermore, an inclusion of security within the Road to Autonomy Index is not a recommendation by the Road to Autonomy Indices, LLC, to buy, sell, or hold that such security, nor is it considered to be investment advice.